Order blocks promise to show you where institutions trade. But does the evidence hold up? Here's the truth.
Order blocks, fair value gaps, liquidity sweeps, break of structure. If you've spent any time on trading TikTok or YouTube in the last few years, you know the vocabulary. The pitch is always the same. These patterns show you where the big institutions place their orders, and if you can spot the zone, you can trade alongside them. It sounds powerful. It sounds like an edge. And today I'm going to walk you through what that claim actually rests on, what the evidence says, and the one filter that separates a real trading edge from a marketing funnel. Keep that filter in mind. We'll come back to it. First, let's define the thing. In Smart Money Concepts language, a bullish order block is the last bearish candle before a sharp rally. A bearish order block is the last bullish candle before a sharp decline. The theory says institutional buy or sell orders were accumulated inside that candle. When price returns to the zone later, it's supposed to react, bounce, or reject. Some teachers add refinements, mitigation. Price tagging the zone and reversing becomes the entry signal. Others want a fair value gap inside the block. Others want a break of structure first. And here's your first red flag. The rules change depending on who's teaching. Last opposite candle only. Last opposite candle with imbalance. Refined inner range. There is no standard definition. And in any field, physics, medicine, finance, when the definition shifts between practitioners, the framework usually isn't built on solid ground. Now let's pull the core claim apart. The order block thesis rests on a chain of 4 assumptions, and each one deserves scrutiny. Assumption 1. Institutions leave identifiable candle footprints. Here's the problem. Institutional desks execute through VWAP and TWAP algorithms. Those algorithms are designed specifically to avoid leaving a footprint. That's the whole point. A pension fund moving $1 billion doesn't dump it into one candle. It slices the order across hours or days to minimize market impact. No microstructure research supports the claim that you can read institutional positioning off a candle wick. Assumption 2. Those zones are predictable and revisited. There's no proven mechanism by which institutional accumulation in one candle produces a price reaction on a visit weeks later. Assumption 3. Traders can identify the correct zone in real time. This is where hindsight bias does most of the damage. On a clean post-hoc chart, the order block is obvious. On a live chart, you've got multiple candidate blocks at any moment, and you only know which one mattered after price has already moved. And assumption 4, the only one that's actually testable, reactions can be profitably traded after costs. As of 2026, 0 peer-reviewed studies have shown order block-specific strategies outperform simpler frameworks once you include spread and commission. 0. That's the number to sit with. Now zoom out. Order blocks are a specific form of technical analysis, and the broader academic record is mixed and weakening. Park and Irwin's 2007 review in the Journal of Economic Surveys looked at 95 technical analysis studies. 56 reported profitable results. 20 reported negative. 19 were mixed. Sounds positive, until you read the methodology notes. Many of those profitable studies suffer from data snooping bias. Researchers tested many rules and reported only the winners. Transaction costs were often ignored, and the strongest results clustered in FX markets in the 70s through the 90s, when those markets were less liquid and less efficient than they are today. Post-2000 data has produced weaker results. The most plausible reading is that whatever small edge technical analysis once offered has been arbitraged away as markets became more efficient. So why has SMC content exploded since 2019? Because the marketing engine is excellent. The pattern is consistent across nearly every popular instructor. Step 1. A charismatic explanation of the framework. Step 2. Post-hoc chart annotations where every block looks like it worked. Step 3. Short, curated live trade clips selected for the wins. Step 4. The funnel. Courses, mentorships, signal services, custom indicators, prop firm affiliate links. And Step 5. Rapid monetization. The audience is monetized faster than any real trading edge could plausibly be developed and verified. And here's the structural piece most viewers miss. Many SMC educators earn affiliate revenue from prop firms, firms that profit when challenge candidates fail. The incentives don't point at student profitability, they point at student volume. None of this is a moral accusation. Many instructors sincerely believe the framework works. It's a structural observation. The marketing of order block trading vastly outpaces the evidence behind it. Now, in fairness, there is a defensible kernel here. 3 observations that survive scrutiny. Strong moves often originate from prior consolidation zones. That's been documented for nearly a century. Wyckoff wrote about it in the 1920s. Markets sometimes retest the origin of impulsive moves. That's a feature of trend behavior. And round numbers in prior swing highs and lows act as reaction points. That's empirically supported. But notice what's happening. None of those 3 observations require the order block framework. They're consistent with simple supply and demand analysis or basic support and resistance. The SMC vocabulary doesn't add predictive content, it adds vocabulary. So if, despite all this, you still want to trade order blocks, here's the discipline. Write the rule down, not the last bearish candle before a strong move. Specify everything. Time frame, structure break threshold in pips, candle definition. If a second person reading your rule wouldn't identify the same blocks on the same chart, you don't have a rule, you have a feeling. Then backtest. Take 12 months of H1 Euro USD, apply your rule, include realistic spread and commission. Measure win rate, average win, average loss, expectancy. Most retail SMC traders never do this. Then size your risk at 0.5 to 1% per trade. Order block strategies typically run win rates around 40 to 55% and need a 1 to 2 reward to risk to break even. Position sizing is non-negotiable. Journal every trade and cap your initial capital. Treat the first 6 months as tuition. And here's the actual finding from decades of trading research. The discipline of risk management, small positions, hard stops, no revenge trades, no over-leverage, has a larger effect on retail outcomes than the choice of strategy. A trader running a mediocre system at 0.5% risk with a journal will outperform a trader running an exotic SMC framework with no position discipline. Strategy is a hat the trader wears. Risk management is the trader. Which brings us back to the filter I promised at the start. The single best test for any trading education claim is this. Show me the audited track record. Multi-year, independently verified, real money, not demo, not screenshots. No popular SMC instructor has published one. If a strategy genuinely outperformed at scale, that audit would exist. The absence is the answer. So here's where I land. Order blocks aren't a scam. Some traders do profit from them, just as some profit from many approaches. But the gap between what's claimed and what's evidenced is unusually large. Strip the institutional mythology. Keep the defensible kernel. Consolidation, retests, round numbers, and put your energy into the things that actually move retail outcomes. A regulated broker, micro position sizes, a real journal, fixed fractional risk, and the patience to accept that year one is mostly tuition. The vocabulary is the easy part. The discipline is the edge.
Strip the mythology. Discipline beats vocabulary every time. Full breakdown linked in the description.